First of all, everyone, thank you for joining. We are so excited to have you here today in our first questions and answers session with Mr. Ryan Lange. I'm very excited to have him on board. He's just a great wealth of knowledge, and it's wonderful to have you here.
Thank
Now,
you, Amy.
of course, of course. So this is at our daily training time anyways. So if there's a few users who have been with us for years, if you haven't been joining, this is the same time every day that we will do our regular questions and answer session regarding the platform itself, as well as updates and training sessions. So definitely join those. There's a main registration link always posted on the Annuities Genius dashboard. We are also hoping to host this same event in the future as well. So keep an eye out for that. In addition, for any of our users who are here today, David Novak wanted me to pass along a very special message. If you send us referrals or get us in connection to your FMO or IMO, talking about perhaps an enterprise deal in providing Annuities Genius to a larger number of agents and increasing those production numbers and greater numbers of success, he does have a special offer. So he will give you a discount or some sort of special offering. So he wanted me to throw that out there for our users. If you send us referrals and get those conversations going, you will be rewarded. Whether that's a discount or a free month of Annuities Genius, that'll be at his discretion. But we want to spread the love. Hopefully you're all experiencing great success utilizing the platform. So we want to continue that forward and get it in the hands of as many agents as possible. Now, without further ado, we're about 4 to 5 minutes into our call, so hopefully everybody has had the opportunity to join if they're going to be able to make it this morning. And I am going to pass it over to Mr. Ryan Lange, the Senior Director of Wealth Management at the S&P Dow Jones Indices.
Thanks for the intro, Amy, and thanks for everybody joining the call today, this morning or afternoon for those on the East Coast. So as Amy mentioned, my name is Ryan Lange. I work for S&P Dow Jones Indices. I joined the company back in May of this year. The main focus that I have is providing index education and helping so I'm here as a free resource, just providing that education and making sure that people understand the various indices that are available and being used, and answering questions and giving extra talking points as you utilize them with clients. So I'm trying to share my screen. Can you see my screen, Amy?
I see that it says you have started the screen sharing.
It's just kind of spinning on my end. Let me see.
It might be taking a moment to load up here.
Okay, it seems to be running a little slow, but as it gets pulled up, I think it's usually helpful if we keep it more conversational. So I welcome lots of questions, hence the Q&A part. So as you're curious about different things going on in the indexing side, different indices within the insurance space, whether it's IULs or annuities or other types of solutions, feel free to ask them. I can give you my perspective on some of them and give you some updates as far as what's going on, what's driving performance, how to think about different indices and different types of market environments. So if you have some views on what types of markets to expect in the years ahead, you can position that in your clients' budgeting or index selection within the insurance products going forward, and kind of close that loop. So as we get started, let me actually just pause as we get started and see if anybody wants to jump on and ask any initial questions to kind of kick it off. If not, I do have a few slides prepared to go over some various topics, but as I mentioned, it'd be helpful if we keep it more conversational. Anything out of the gate?
And do you see that Q&A bar at the bottom of your screen, everyone, as well? I just want to make sure if you're not familiar with Zoom, you know where to find that. There should be a bar present at the bottom of the screen where you can click on that questions and answers section there.
And while we're waiting for some questions to come in, there was one that was submitted in advance that Amy passed along to me that I can kind of work on unpacking. There was multiple questions in there, but it does kind of get to the heart of some of what's going on in the industry right now and how to think about things. The beginning of the question says, many indices are very new. How is the performance reconstructed and how valid is it? And are they subject to regulatory oversight? And the way that I would look at that question is, while there's not like a predefined regulatory oversight of all indices out there, the different index providers generally have their own panel or team within the company that will overview or review the various methodologies and make sure that things are constructed and managed in appropriate fashion. S&P, since we focus primarily on just the indexing side, where some other companies will do the indexing in addition to providing hedging services or other asset management services. We obviously take the indexing side very seriously. And what I put up on the screen is our index governance. So we do have a very strict index governance for any indices that are S&P branded. They go through the same process. So it is a very rigorous process for any new ideas that come up for a new index, for it to go through, create the methodology. If there's back-tested performance in there, they want to make sure that that's all calculated correctly and things follow a certain narrative as we go forward. The last thing we want to do is just data mine and look for strategies that would have worked going backwards, but maybe don't stand up to the credibility going forward. And make sure that people are understanding and utilizing it the right way. So I wanted to at least put that up there so everybody knew the S&P process for new indices that are being launched, and also existing indices that are on the shelf and have maybe been around for some time. Not only do they go through that process up front, but they are also reviewed annually as well to make sure that everything is still following the rigor that was originally set for the underlying indices.
Wonderful. That was
Yeah,
great information. And there is a question from Thomas in the questions and answers.
yeah, I saw that one come in. So it says, can you briefly describe what is an index and how are they structured? So the way I would think about an index is, a lot of people will think of an index as like a passively managed solution for managing investments. Now, while it's passively implemented, it is actively managed behind the scenes as far as the methodology and how they are put together. Obviously, one of the most well-known indices available is the S&P 500 that has been around for some time. There are active rules in there as far as which companies will be in the S&P 500 and which ones will not, that is regularly managed. So there is active decisions being made, but then the implementation of it is very passive. So it provides you an institutional level of asset management and a more predefined structure, so everybody kind of knows what to expect out of the index. Obviously, the S&P 500 is one index out of many that are available out there. But it's kind of the same process where you can also take a look at a fixed income index or a multi-asset index that will blend together equities and fixed income and other types of asset classes. And it follows the same process. It's actively rules-based put together for it to create that methodology and then passively implemented on a go-forward basis. Hopefully that helps answer your question. One of the other things that I think has got renewed focus, especially in the last year, is as interest rates have gone up, and a lot of insurance companies have been raising their participation rates, their cap rates on the S&P 500 and other indices that are out there. There seems to be a renewed focus of moving back towards the S&P 500 crediting option. And I think there's a lot of confusion about the risk control indices as far as what to expect, what are they, why are they in the insurance solutions and so forth. So one thing that I thought would help is we do have this slide just providing an overview of how risk control indices work. And then I can kind of unpack a little bit more beyond this. But essentially, a risk control index is targeting a certain level of volatility. It looks like a question just came in talking about the volatility indices, which is the same as what we call our risk control indices. So with that, if you're trying to target a specific level of volatility in an index, the exposure that the index is going to have to the underlying asset classes has to constantly change based on the volatility that the public markets, whether it's the equity markets or fixed income markets and others, are seeing. So there's a lot of various risk control indices out there. Some of them will have one base index, like an S&P 500 daily risk control 5% index is one example. So that'll take the S&P 500 index and manage it towards a 5% level of volatility. And I'll get into more detail what that means here in a minute as well. So what that means is as the volatility increases of the base index, so use that S&P 500 index as an example. If the volatility of the S&P 500 is going up, the weight to that parent index is going to go down, and the cash weight or sometimes fixed income weight, depending on what asset classes are all put in there, may go up in order to maintain that volatility target. The inverse is also true. So if the volatility of the parent index is going down, then there will be more allocation to the parent index targeting that volatility. Using some simple math, if the index is targeting a 5% volatility level, but the S&P 500 is currently experiencing around 15% volatility, then you'll have around 1/3 exposure to the S&P 500 and the other 2/3 in cash. It does get a little bit more complicated when there's more indices within the risk control index versus just the parent index and cash, but they all essentially kind of work that same way where they're trying to target that volatility. I think one of the things that is important to understand is why does this matter in the insurance marketplace? What the reason, the way to think about that from my perspective is remember that your clients, if you're picking an index for a crediting option, the insurance company is not holding the underlying exposure. So if you pick the S&P 500 or the S&P 500 risk control index or any other index available, the insurance company is hedging behind the scenes, but not actually owning those assets. And one of the primary tools used for hedging are option contracts for those that are familiar with the various derivatives on different indices that are out there. The option contract, if you can target a certain level of volatility, let's say it's 5%, 8%, 10%, whatever that level is, the cost of that option becomes more stable. So as you come up for renewals for your clients, the hedging that the insurance company is going to have for a risk control index is going to be much more static or stable than those that are following an index that is not in the risk control wrapper. So if you're looking for more stability on the renewal rates, I think it definitely helps on that side of things. The other way of thinking about like what does that volatility mean? And I think this question also comes up a lot. Like if you going back to the S&P 500 5% daily risk control index, if you're targeting a 5% level of volatility, what does that translate to? And I'm sure most of us have not taken our statistics classes in college for some time, but it's a measure of standard deviation. And kind of walking through like a hypothetical example, I just pulled up a simple tool that you can all find online. And the way I would think about it is if you take that index, you can plug in your expected rate of return. So I just threw in 5% to start. And then the standard deviation, I put 5% as well. So that's the volatility part. So it would graph out the probability of returns across a spectrum down here. That volatility number, so if you take your average rate of return or your expected rate of return of that index going forward, which everybody can kind of come up with based on their own assumptions, and then you add or subtract that volatility number on either end of that, that's going to be one standard deviation, and it kind of highlighted down here, and it's going to cover around 68% of the time, or about 2/3 of the time. The other way of translating that I think can resonate either to help understand yourself, or if you're really getting into the weeds with some clients, is about every 2 out of 3 years, you would expect the returns to fall within that level of distribution. You could also go one more standard deviation out, add or subtract another 5% on either end, which will go down to -5% on the lower end, positive 15% on the upper end, and that's going to be about 95% of the time you would expect the range of returns to fall within there, which also translates to about 19 out of every 20 years, you would expect the returns to fall in there. So you can see as that risk control number gets smaller, that range of returns also gets smaller, and you're going to have more consistency in those returns. As the volatility or risk control number goes higher, your range of returns is also higher. It means you could have years where the returns will be higher if the equity markets are trending up, but it also means that you could have years where it's going to be lower if the equity markets are down. And it also translates to the participation rates or par rates that insurance companies will offer. Obviously, the wider range of returns, the less potential upside you're going to get multiplied by that index. The smaller that number, they may offer a little bit more upside because it's going to be more contained within that level of uncertainty on a year-over-year basis. So hopefully that helps kind of think about the risk control side of things a little bit more and how they work. I also have another visual in here. We have this white paper on the S&P website talking about risk control indices that I can share with any of you if you would like some follow-ups. But I picked a couple of charts out of here just to kind of highlight this point. And this goes back to 1990 up until I think this was run through mid-2021 when they had done the paper. The S&P 500 graph, this is a performance chart going back over this time period. This pink line that's kind of mixed in here is just the S&P 500 by itself. And then there's various levels of risk control lines. And you can see as you go from 5%, 10, 12, 15, you get closer and closer to the parent index of the S&P 500. The one that stands out the most is the 5% risk control because that's going to put more constraints on how much allocation to that parent index there's going to be. The chart on the right also graphs out the returns of the S&P 500 by calendar year. The further to the left are the better returns for the S&P 500, and the further you go to the right are the worst returns on an annual basis for the S&P 500. The daily risk control 5% index is that brownish color dot that's in there. And you can see how regardless of really strong returns or really poor returns, the range of annual expectations for that level of risk control index is going to be much tighter as designed by these indices. And it's also why you might see an insurance company that offers par rates on the S&P 500 of, let's say, 30 or 40%, but you might see par rates on a 5% risk control index and 150, 175. I've even seen closer to 200% now going up there because of the difference in volatility control that is in there. Looks like a couple other questions came in. One says, if I have the S&P 500 index at a 50% part, I know I would get 50%. Who gets the other 50%? I'm not sure if I really understand the heart of that question. It might be on the risk control side on kind of coming back up here. So if you're getting 50% exposure to the parent index, who's getting the other 50%? It's just sitting in cash. Nobody's getting it. It's just the hedging. And maybe to unpack that a little bit more. So the way that insurance companies are working, so as the client money comes in, if they buy a fixed index annuity, the insurance company is going to take part of those proceeds and use for their hedging budget. The amount of that budget heavily depends on the interest rate environment. So over the last year or so, as interest rates have moved quite a bit higher, most of the insurance companies have had a larger hedging budget to go out and buy options or other hedging instruments on the underlying index. So as the hedging budget goes up, they can buy more notational exposure on the parent index, hence the higher participation rates and higher caps and other various components on the indexing side. So the other 50% in that hypothetical example would just be sitting in uninvested cash and being used as a way to manage the volatility towards that target of, let's say, 5% in the example that we had walked through before. Question, does the S&P 500 monthly crediting return more than annually? That's going to be also highly dependent on the environment that we are in, the market environment. It's hard to say whether one crediting option is going to work better or worse than the other on a consistent basis, because it's really going to be dependent on those paths of returns that we have. And that's going to be also the same for looking at the S&P 500 versus like a risk control index as well. So if you take a look at those two, generally speaking, and if you take a look at kind of historically speaking, in environments where the equity markets have lower volatility, you will generally get better returns when you factor in the higher participation rate and the return of the underlying index for those risk control indices. In environments where the equity markets are trending higher, but there's a lot of volatility and they're very choppy markets, you might do better with just the S&P 500. The reason why that's the case is if there's lower volatility in the parent index or just in the markets in general, you'll have more notational exposure to that parent index when the markets are moving higher. And because you generally have higher participation rates in those risk control indices, when you multiply the two of those together, it can lead to pretty good results. But the inverse is if the S&P 500 has a lot of volatility, the notational exposure to that parent index is going to be very low. So let's say the S&P 500 volatility is 40%, but you're in a 5% risk control index. You're only going to have 1/8 exposure to the S&P 500, and the other is going to be in uninvested cash. But if you compare that to a market environment where the volatility of the S&P 500 is 10% instead of 40%, you might have 50% exposure to the S&P 500. So it can lead to very different results depending on the volatility of the equity markets. Obviously, this year, as volatility has moved higher, you've seen a lot of those, or most, if not all of the risk control indices have moved their notational exposure down, which protects the performance when the markets are moving down because you have less exposure in a downward moving market. But it also means as things turn around, like when there's a sharp rally in the equity markets, you're not going to capture as much of the upswing as things are coming back. So just different things to think about in different types of market environments, lower volatility versus higher volatility markets. Got another question from Tim. How much difference is there in a daily versus dynamic rebalancing frequency? By dynamic, I assume you mean intraday, if I'm interpreting that correctly. There's going to be some difference between the two. Our team at S&P is actually working on some intraday hedging indices that will hopefully be available and launched in the next year or so. And the daily rebalancing frequency is going to take a look at the volatility at the end or close of each business day and make adjustments to the index at that time, where an intraday one is taking a look throughout the day and making adjustments during the day. That's going to matter a lot more in environments where there's a lot of volatility during the day. So if you go back to March of 2020, when some days the markets, the equity markets may have opened 5 or 6 or 7% down and then close the day 5 or 6 or 7% higher. If you're only looking at the end of the day, you're not capturing all that intraday volatility and making those adjustments. But if you have an index that's looking throughout the day and making those adjustments, it can make a difference there. And performance-wise, it doesn't make as big of a difference historically, but you might have a little bit more participation in there, because if you think of it from a hedging perspective, the more closely you're tying everything and maintaining your target volatility, the better the pricing on those options and the hedging can be within it as well. Another topic that's come up quite a bit in the last year, as far as understanding what the difference is, and the importance has grown quite a bit as interest rates have moved higher, is what is the difference between an excess return and a total return index? Simply put, the excess return index, or the difference between the two, is going to be a difference in short-term interest rates. So when you think of option pricing, there's 3 main variables of option pricing. One is the time to maturity, which if it's an annual point-to-point crediting option, regardless of the index, the time to maturity of the index that you're hedging is going to be consistent. Two is volatility, which we just touched on. The importance of the risk control indices is they manage towards a specific level of volatility is to try to keep that more stable. The third is interest rates. So as interest rates move higher, the cost of hedging and the cost of options also goes up. Now, the excess return indices are going to subtract that funding cost to keep the hedging more consistent for insurance companies and keep those renewal rates probably a little bit more stable as well on a year-over-year basis. But it also leads to lower returns in market environments where short-term interest rates are higher. To highlight this point, the chart that I have up on the screen goes back to 1991. It is comparing the S&P 500 5% daily risk control index, the total return version, which is the red line per year, and the black line is the excess return index, which backs off that change in short-term interest rates. In the bottom part of the chart, I just subtracted the two so you can see the difference in return between those two indices. And for those that have been in the financial markets for some time, you'll remember that back in the 1990s, interest rates, especially short-term interest rates, were quite a bit higher than they have been for most of the last 10 or 15 years. So you can see the difference between an excess return and a total return index is going to be much greater. Then as you get to the time period of about 2000 to 2003, when we had a recession following the dot-com bubble, you can see that the difference went down as the Federal Reserve was cutting interest rates, and the return between the total return and excess return index is going to be more consistent with one another. Then as the economy recovered, the Federal Reserve was raising interest rates from 2003 to about 2007. You can see that return differential picked back up again. And then the financial crisis hit in 2008, and you can see it came back down where interest rates were near zero for some time. And during that time period, whether you picked a total return index or an excess return index, your return is going to be very, very similar to one another. Then we got to another Fed rate rising cycle from about 2016 to 2018. And you can see that picked back up again, and then COVID hit, and then short-term interest rates came back down. I don't have 2022 on there yet, but because of how quickly short-term interest rates are coming back up, the return differential between a total return index and an excess return index is going to be much higher again. So keep that in mind if you're looking at different index options within an annuity contract. On if there's vastly different participation rates or par rates, it might have to do with it being a total return index versus an excess return index. Where that becomes most important is going to be years like if you pick out 1994, 2000, the year 2000, and a few others where the total return index had a positive rate of return. The excess return index, because you back out those interest rates, had a negative rate of return. It could lead to a difference of whether your clients are getting a positive crediting rate for that year or not getting, or just getting a 0% rate of return for that year. So definitely something to keep in mind now as rates have continued to move higher, and watch as we go forward in the years ahead based on what the Federal Reserve is going to do with interest rates. Looks like we got a couple more questions that came through. One says, so with the greater control of risk management, the cost of the call options is controlled and reduced to a greater extent, correct? Which means more money for the client ultimately. I don't know if that means more money for the client. It means that they're going to offer higher participation rates because their hedging can go further with a lower volatility index versus one that doesn't control for that volatility or has a higher volatility index. Generally speaking, the returns for an index with more risk control and can kind of constraining that level of return year over year, the more you constrain that over time is going to likely lead to lower performance of the index. But because the annuity business is different and you got to multiply that by your participation rate, that's the equalizer. So you got to kind of think about the difference in return expectations for that risk control index versus a non-risk control index, and then factor in that difference in par rates. And as I highlighted earlier, generally speaking, in periods of lower market volatility, where the equity markets or bond markets are moving higher, you'll see better results with some of those risk control indices because they're getting more of that exposure on the upside. Another question, can you explain from your perspective, how can an insurance company give a 200 or 300% participation rate and still make money from the particular index? That really also comes back to the level of risk control. The higher the interest rate environment is, the more money that the insurance company is making in their general account from investing in shorter term fixed income instruments and other types of investments, the more they have to go out and buy the hedging on the underlying index. So if you have an index that has a 5% risk control wrapper on it versus one that has an 8 or 10 or 12 or doesn't have a risk control wrapper on it at all, you're going to see those higher participation rates. The other part that comes into play with some annuities as well is they'll allow you to buy up the exposure to the index, and they can take that extra money that clients are paying for, like from a fee, to pay for higher participation rate and buy more hedging out in the markets as well. So that's kind of the client would be subsidizing part of that extra participation rate at the same time. So again, different things to think about in different types of market environments. I think a lot of the risk control indices with lower levels of volatility, like 5%, quite a few of them were created when the interest rate environment is quite a bit lower, and as a way to offer potentially more upside if the markets did well. But now that interest rates are higher, I think is why you're seeing greater than 100% participation rate on quite a few of them going forward. But also, again, keep in mind that if it's an excess return index, that's also going to come into play as well, because you're going to subtract part of that performance based on the short-term interest rates in the marketplace. So higher interest rates mean lower performance for an excess return index, which means that the insurance company can offer more participation in there as well. So just keep that in mind when looking at some of the different index options and participation rates that are out there.
Wonderful. I don't mean to interrupt, Ryan. I just want to make sure that you are aware of the time. It is 9:35. I mean, we are grateful to have you as long as you would like. This is such wonderful information, but I just wanted to make sure that was at your attention.
Yep, keeping track. So
Perfect.
if there are more questions that come in, I can definitely answer them here in the next handful of minutes. I put up a slide with some of the more widely used S&P indices within the annuity marketplace right now. So if there's any questions on specific ones, I could talk about the underlying composition and what's going into some of them as well. So you can think about the different market environments and what to kind of expect, both looking backwards and what to kind of expect on a go forward basis. Outside of that, I just want to make sure I address some of the other questions that came in the email in advance too. I think so part of the question that came in advance is agents are selling, or hypothetical returns are becoming more misleading, yet agents are selling them hard, which makes for a lot of consumer abuse and tough competition. The question is, what recourse is there for that? I can't really answer whether there is or is not recourse. I guess it depends on how it's sold. And it says, are par rates mostly determined by interest rates, which we talked about a little bit earlier. Are there volatility and enhancement fees mostly driving them? Part of it is the control of volatility, and the other part is interest rates, which we talked about. Now, the thing to keep in mind as far as illustrations is if you're utilizing the historical returns of some of these indices going back for the last 10 years, and you're assuming that you had the current level of par rates or participation rates on them, that might be a little deceiving, because if you go back 4 or 5 years ago when interest rates were near zero and insurance companies didn't have as much of a hedging budget, those participation rates were quite a bit lower than they are right now. So if you were investing client money during that time and you multiplied the participation rate times the return of the index, you're not going to see the levels that you'd see right now using current assumptions inside of there. The other thing to keep in mind is some of those illustrations, they stop at calendar years. So if they're not including 2022 yet, which will likely be a negative return year for most indices, or a 0% crediting for a lot of clients, that's also going to be somewhat of a factor as the 10-year period rolls forward to another year at the end of this year. That will have some impact as well. But probably the biggest impact is just the difference in interest rate environments and difference in par rates, participation rates, caps, now versus most of the time period going back for the last 10 years. It's not a good example of what clients would have expected. It's not to say that they won't or can't see that level of return going forward, because if interest rates do stay higher and equity markets recover, fixed income markets recover, et cetera, and those assumptions stay flat, like, it is possible. But again, it's not a good representation, as good of a representation going back. One question came in: do any of these indices have gold within them instead of cash? Yes, the Mark 5 index, the second bullet point on the screen there, is a widely used S&P index within the annuity space. That one does have gold in there. So the components are the S&P 500, the 10-year US Treasury, and gold, and is targeting a 5% volatility level between those three indices. And the weight of them is determined by the volatility of the underlying asset class. So the less volatile the asset class, the higher the weight, and vice versa. And then the overall weight is adjusted in order to target the 5% level. I actually have a visual for that here. So this is the Mark 5 index, the historical allocation. Most of this is back tested to the late 80s or early 90s. And the bottom color here is the equity or the S&P 500 exposure. The dark blue is the 10-year US Treasury exposure, and the light green is gold. So you can see in environments like the financial crisis, the overall exposure came down quite a bit. Other environments where volatility is low, like 2016, 2017, you can see you can get more notational exposure here and more potential upside. But this is one that does use gold in there for that commodity exposure. This index was actually designed for the use in the insurance market because of the liquidity of the underlying instruments. The S&P 500, 10-year Treasury, and gold are some of the most liquid indices out there from a hedging perspective. So it makes a much more efficient use for insurance companies to do that hedging. But you can see how dynamically it's adjusted based on the volatility of the markets going back. Another question came up, and I'll kick this one to you, Amy, about getting the replay of the video.
Oh, absolutely. Yes. So we are recording this entire webinar from start to finish, and it will be accessible through the Annuities Genius platform. Within, it'll say on the left-hand side, we have all of our account information, and then the Genius training. And if you'd like to access the webinar recording, it'll be there in a couple of days. We've just got to get it downloaded, edited, and then re-uploaded within there. But feel free to send me an email or call the office if you have additional questions. And in addition to that training section where the webinar will be posted, we also have daily trainings from 9 until 9:30 focusing on the software itself. Obviously today is a special event, but if you join those as well, we'll teach you how to navigate all the ins and outs of the software and also how to find those webinar recordings. We also have one from the past with Tom Hegna that's a great resource. So it's a good idea to know where to find those things. But yes, there will be a recording for you.
The other thing to point out is there are additional resources available within the S&P website for the underlying indices primarily used in the insurance space. We have a landing page just for insurance called the S&P Dow Jones Indices Insurance Resource Center. There's a link here, but you can probably Google it and find it as well. There's information on each of the underlying indices. A lot of them also have a monthly dashboard that's put together, so you can see the performance of the index, both the excess return and total return index, and some of the underlying indices that are made up within it. You can see the return going back generally year to date or sometimes trailing 12 months. You can see the notational exposure of the underlying indices at the bottom as well. Could be a good resource to follow. S&P also does have some daily dashboards that are available for some of you that just want a quick snapshot on what happened in the financial markets and economy the day before. This is an example of one that our team sent out this morning. So it's a quick read for 1 or 2 minutes to start your day that some people really like as a resource, just to kind of stay on top of what's going on in the markets and provide some talking points for clients. In addition to this, our team also hosts a weekly call talking about different timely things in the markets, and we'll usually have a guest host, either internal S&P individual or sometimes an external individual, just talking about different topics as well that you can sign up to if you want to get more information as far as what's going on in the market environment. And feel free to reach out to me. You can either reach out to me through Amy or anybody at Annuities Genius, or directly. My contact information is on the slide at the front. I have my email and telephone number in there. So if you have more questions or really want to get into more of the details of a specific index or comparing multiple indices, I'm happy to do so. I enjoy those conversations, so don't hesitate to reach out so I can be a resource for you and your clients as you see fit. So barring any other last minute questions, I'll hand it back to you, Amy.
Well, thank you so much, Ryan, for being here and for just doing this wonderful webinar with us. It's been such an informative experience. Richard, you can contact me through my email. It should already be in the general chat area, but it's my first name, AIMEE, and then at annuitiesgenius.com. Then the phone number to the main office is, if everyone is ready, 949-600-7707. So you can reach out via phone or email. And on the main dashboard of your Annuities Genius, you can also access our daily training webinars, and I am the person that hosts those. So I'm happy to answer any questions that you have in the morning as well. Oh, of course, Richard, thank you so much. Absolutely.
So I guess the one last question that came up from Eric, I guess I can just give my perspective on this, but it asked whether when either allocating in the application process or renewing each year for the annuity, is it wise to use the Annuities Genius top 4 allocations? And Amy, I think I'll rely on you on this a little bit as well, but I believe those are the ones with the highest historical illustrations, right?
Yep, highest rate of return just back tested over the last 10 years. And so that's sort of automatic. I would definitely recommend doing your own research into the indices and choosing your own allocation strategies. That's more of it's there for you to use. It's a tool, but definitely advise that you do your own research and digging into these different indices, especially as we've seen today, there's so many details that go into it. So I would highly recommend really thinking through your allocation process rather than just clicking on, our generic, hey, top 4.
Yeah, and as Amy pointed out, and we talked about it, it's a tool. I wouldn't solely rely on that. If you assume that whatever worked in the past is always going to work better going forward, I guess you could use that approach. But as we all know, that's not usually the way the financial markets work. And just thinking more strategically on picking one or multiple indices and pairing them together can probably lead to better results, especially if you have different indices that perform better or worse in different types of market environments. If you're splitting those allocations, there may be some years where one index will be negative, so you get a 0% credit on it, and the other index is a positive rate of return, and you're at least moving higher each year. And understanding how to pair them together. And if you as an advisor have your own views on the markets that you want to tie a lot of this into, understanding how the indices are constructed and what the underlying composition is, you can utilize that and allocate to the ones that are fitting your overall narrative of the markets as well. So Kevin asked, how do we start receiving the market updates each day? Send me a quick email and then I can share that with you and make sure that you get signed up for it.
And also, if you have access to the Annuities Genius Prime version, there's a tool in there called the Index Tracker. And we have the related information for every index that we do track. So if you click on what we call the ticker symbol right there, will actually take you to that particular website where you can see the live performance. So that's also a really wonderful resource to have access through via that Prime subscription. And if you're able to join that daily webinar tomorrow, that's definitely one that I'll touch on for you all. Perfect.
Well, thanks for having me, Amy. I enjoyed the time and hopefully everybody found this insightful. And like I said, if there's anything else that Amy can help with from the Annuities Genius side or I can help with on an indexing side, feel free to reach out to us and we're happy to partner and work with you.
Wonderful. Thank you so much again for coming, Ryan. This has been a really, really wonderful webinar. I know that I personally learned a lot and I hope all of our attendees did as well. I'll look forward to speaking with you in the future and hopefully hosting more wonderful webinars like this one.
All right. Thanks again, everybody.
All right. Have a great day.
Yep. All right. Bye.